Welcome back to another episode of Palisade Radio. I'm your host, Karim Mamutlu, and on today's show we welcome David Erfle, who is the founder of JuniorMinerJunkie.com. Welcome back to the show, David.
Thanks, Karim. Great to be back. I always like talking to you.
You were on the show a little more than over a year ago, and in regards to the precious metals and juniors, the sentiment since then has definitely shifted, and the recent move in gold now appears to be taken more seriously. So talk to us about sentiment today. I know you've been to a few conferences recently, and before the call we were talking about your experience at Beaver Creek. So what's your take on the precious metals, and are we still very early? How would you describe where we are today? Perhaps quiet optimism is the phrase we could use for this sector?
Yeah, I think that's a fairly correct term to use here. It's really interesting. It's a bull market for many of these miners and some of these developers and explorers, but the early stage micro cap explorers, it's still pretty much a bear market. The capital markets really haven't opened up for a lot of these companies. There's a lot of frustration in management in some of these micro caps who are not able to raise money, even though the gold price is sitting here at $1,500 an ounce.
Earlier in your career, I understand you sold your house and put the proceeds into a few gold and silver juniors. And when those tripled, you were then in a position to quit your job and focus on the industry full time. So let's talk about that. As an investor, how hard was it to sell your house in the mid-2000s and do that? Did friends and family think you were crazy, considering back then we were in the middle of a housing bubble frenzy and sentiment was so bullish back then for housing? And did you have a sense that housing was going to top out? Talk to us about your journey.
Yeah, I don't recommend this at home, selling your house and putting all your money into juniors, but I did a lot of research. I was really getting into the housing market and following it and watching from the sidelines, watching how crazy it was becoming, especially in Southern California. I purchased my house in 1999 and I saw the height the market was going to, and I was doing a lot of work on the house as well. It was an old house built in 1910 in Pasadena, and I was doing all the work myself, restoring it. And when I purchased, I planned on staying there for quite a while. But as I saw what was going on in the sector, and I just said, well, wait a minute, I'm doing all this research on this junior mining sector, and in order to have a nice little grub stake to put into a lot of these juniors, which I think are going to do very well over the next few years, I think it'd be probably a good idea to sell my house, which is basically at the top of a market, and put all the money into juniors, which had been consolidating for a few years after the huge move from 2001 to 2003, and maybe make a little money and maybe have a career change. And that's exactly what happened. I was very fortunate to get the timing right. And now I do this full time, and it's been a crazy ride. I didn't have a home for about 5 years. I put all my things in storage after I sold the house, and lived in Buenos Aires for a couple of years. I lived in Australia, I lived in London. And it was a crazy journey, but I learned a lot. And now this sector, like I said, I'm doing this full time, and it's been a very fun and interesting and a very learned experience.
Very good. Okay, I know the HUI to gold ratio is one chart you like to keep a close eye on, David. So let's talk about that and why it's important from a big picture perspective for investors out there.
Yeah, that's a really interesting question with a lot of different phases to the answer here. If you take a look at the HUI to gold ratio now, it's basically where it was when gold double bottomed at $250 an ounce in 2001. And a big reason why these miners are still so cheap, a lot of it has to do with dilution. Because in the late 2000s, when the gold market was getting very frothy and getting towards that $1,900 an ounce, a lot of these majors were getting a lot of heat from shareholders of having to replace their ounces. So they did something that has kind of hurt them going forward, which was they spent a lot of their capital, meaning their shares they spent with dilution. They purchased with dilution all these companies these developers that were developing low grade bulk tonnage projects, which needed a much higher gold price, which they were expecting to happen to be economic. Well, as we know, this did not take place, and the GDX ended up crashing 84% from 2011 to late 2015, and a lot of these majors still need to replace their high grade ounces. They still have a lot of these low grade projects on their books. Most of them have been written down, but still, if you take a look at this HUI to gold ratio, it's showing you that the mining sector in general is basically the last deep value play left in the marketplace. I mean, if you look at just about every other sector, it's gone into bubble territory, including pot stocks and crypto and biotech and just about every other sector. But if you take a look at the mining sector, even with the gold price breaking out of a 6-year base, it's still very undervalued.
If we move on to today, in certain terms, the producers have already moved for gold, but what would it take for the juniors to move? A lot of investors are still frustrated that the juniors haven't actually had a speculative phase yet, considering the gold price has jumped earlier this year.
Well, that's another question with a multifaceted answer here, Graham. It has a lot to do with capital markets being very squeamish still, because, like I said, when you have an index go down 84% over 4 years, a lot of people lost a lot of money. And then in early 2016, when we had that jump in the GDX of about 160% in 6 months, capital markets got very excited again, and they went in the other direction and got a little too excited and started funding a lot of projects that probably shouldn't have been funded, and they got burned. So they're very cautious here, and even though the gold price has broken out above 1,400 and has gone now above 1,500, I think the capital markets would like to see at least 2 consecutive quarters of the gold price maintaining that $1,400 floor before they start opening up their purse strings more and going down the food chain into the smaller juniors.
Okay, let's talk about the possibility of gold heading back to its all-time highs and beyond. Will this new cycle, in your view, play out over many years? And what will you be looking for in terms of a top in this bull market, especially for the juniors? What signs would you look for as an investor?
Well, there were a few signs of a top in the last bull market. Well, first of all, I'll tackle the first part of your question. Yes, I do believe that the gold price will eventually rise above $2,000 an ounce. I think it'll take a little bit longer than a lot of these analysts are predicting. I would like to see a slow, steady climb, just like what we saw from 2001 to 2011. That would be a much more easy to invest in. Seeing wild fluctuations in the gold prices, it makes it very difficult to time entries and exit points. But as far as signs of a top, during the last cycle, the signs of a top were buyouts like Kinross buying out Redback, which was a junior, and they paid $1,000 an ounce in the ground for the junior. When you start to see these huge capex projects that are low grade and not very high margin, when you start to see these things get financed that have capexes of billions of dollars as opposed to millions, that will be a sign of a top.
Very good. Okay, let's move on and talk about a few books or authors that have helped you as an investor throughout your career so far, David.
Yeah, there's a few books that I read that really opened my eyes to the sector, and the first one was G. Edward Griffin's Creature from Jekyll Island, which is all about the Federal Reserve, which I'm sure your listeners are familiar with. It's a huge undertaking to read this book and take it all in. It took me a while to get through the whole thing, but it was an eye opener. It taught me how the monetary system functions. And then as far as trading is concerned, Reminiscences of a Stock Operator, which came out in 1923. It's almost 100 years old, but the lessons I learned in it are very prevalent today. And that's about the world famous trader Jesse Livermore. And anything on Jesse Livermore that I've been able to get my hands on to read, I will, because his trading forms and the way he traded and the way he saw things, and he was basically the ultimate contrarian investor, and that's what you need to be in the junior sector to be successful. I mean, if you're buying stocks that are rising, that have already risen quite a bit in the junior sector, you usually end up losing money. It's always a really good idea to buy fishing lines and sell rhino horns, as opposed to the other way around, especially in the junior mining sector.
Excellent. Okay, as we begin to wrap up, David, is there anything else you'd like to discuss with us today? Any other markets that look interesting to you, or is gold and silver and the juniors what you're focusing on now?
Yeah, the gold and silver juniors right now, but the ultimate contrarian play down the road here is the base metals and like copper and zinc and uranium juniors. I wouldn't be getting into them yet, but down the road, I think those are really good contrarian plays to get into a basket of a few copper, zinc, or uranium juniors.
Well, thank you very much for your time today, David. It's been great having you back on the show.
Thanks for having me. Always great to talk to you.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?